Portfolio models have become almost universally used in retirement planning. And if you're entering the retirement risk zone, which is the 10 years immediately prior to retirement and you're in the first 10 years of your retirement, then you've likely asked yourself the question, is my investment mix properly structured for me? And maybe even the follow-up question of, should I consider a model portfolio for myself to suit my purposes? Now, in today's video, we're going to be going through the pros and cons, the trade-offs of using a model portfolio. So hopefully you can use the information in this video to make a better decision about whether a model portfolio is appropriate for you in your particular situation. So what is a model portfolio? A model portfolio is a templated investment mix that has been designed by a professional investment manager that is then outsourced or used and made usable for the general public. Some of the pros, the benefits of using model portfolios are that using one can help save you time, right? You don't have to go become an expert and construct your own portfolio and do hours and hours of research. And it can also reduce what I call decision-making friction, which is sometimes decisions need to be made and they need to be made quickly. And decision-making friction occurs, it kind of gums up the works. It's when someone is hesitant to make a decision because they either don't have enough information or don't feel confident enough about the information they do have in order to actually take action. And decision-making friction can halt someone entirely from making a decision at all. Model portfolio can be useful to eliminate decision-making friction because you have the kind of reputation of the investment manager or portfolio manager who has crafted that portfolio, kind of giving weight to that portfolio and can therefore actually take action and maybe use it at their kind of quote-unquote recommendation. And we're not necessarily talking about a paid model portfolio. We're talking even about things like a Boglehead 2-fund portfolio or 3 or 5-fund portfolio. Often there's some weight behind the name of the person or professional who came up with that model, and that can help reduce decision-making friction. And the third reason that a model portfolio can be useful is that it allows you to delegate, right? You want to focus on the things that you would like to focus on, and you may not be a professional investment manager, and the model portfolio allows you to delegate this responsibility, hopefully, in a manner that is suitable for yourself. And again, there are paid model portfolios and unpaid, and we're not talking about which is better or why to use one or the other. We're just talking about the idea that having some kind of a model to use as a baseline can help reduce decision-making friction. Now, as with everything, there are trade-offs to using model portfolios. And the first is what I would consider the most important, which is that the comprehension is gained in the construction. And what I mean by that is, if you don't build the portfolio yourself, you're always going to have a less than optimal comprehension of what is actually going on in the underlying portfolio. Now, that is a fine thing as long as you understand that that's the trade-off. And this can happen both at the individual level or at the advisor level. An individual or advisor who uses a model portfolio having not constructed it themselves will simply lack comprehension because you gain the comprehension through the execution, through the research that goes into building and the research that goes into back testing and ultimately using that model. Now, in addition, there is a reduction in transparency when using model portfolios. And this is partly just because, again, you haven't built it yourself, so you're not going to understand exactly what's in the portfolio. And I can illustrate this with a quick, easy example. We're going to use a quick, easy example to illustrate how some transparency is lost when using a model portfolio. And I'm going to do that just by showing 2 quick bond funds that are very commonly used in all sorts of model portfolios. These are both Vanguard bond funds. And I just want to illustrate a few of the things that might get lost when you don't construct your own portfolio or don't have someone directly educate you on what's within your portfolio. We just lose sight of certain things. For instance, this is VBTLX, which is a Vanguard Total Bond Market Index Fund. It's very commonly used in a Bogleheads type portfolio. And this is usually going to be proportionally the largest portion of someone's bond holdings in this type of portfolio. The thing to note here are 3 things. One, that this bond fund is composed of a portion of BBB rated bonds. That's just the thing to note, but BBB are certainly not the highest quality bonds. This might be a subset of companies or agencies or countries, whatever it might be, that you might not be comfortable with or not know are in there. You might assume this is all high quality, super investment grade bonds. The second thing to understand here is that the duration or the length of the bonds in this bond fund may be longer than you prefer. And the reason to think about that is, and I have another video on this that you can watch, which talks about how bond funds prices fluctuate, or bond prices themselves fluctuate more aggressively the longer the duration of the bond contract. And this VBTLX fund has about 20% of this fund is comprised of 10-year or greater bonds, which means we're going to have a significant portion of this fund that has high price volatility. And this is the same in VCOBX, which is another Vanguard bond fund that is commonly used. You'll see roughly the same items here. 20% or so of of it is in longer duration bonds, meaning the price fluctuates a little more widely. You also have some BBB rated bonds, and you'll also have, even in here, some maybe commercially backed bonds or kind of derivative based bonds that you might not know are in the fund. And this is not bad or good. It's just to illustrate the fact that when we don't construct the thing, we might not know what's actually within it. Now there's a third thing to show here, and I'll show this is Portfolio Visualizer. This screen is going to show 5 different bond funds over a 16-year period from 2008 to 2024. You can see here that all 5 of these bond funds, regardless of their duration, had almost no real return, less than a 2% return on all these funds. And what you're actually happening here is some of these bonds have significant price fluctuation. So you're getting a lot of volatility in some of these bonds, but if you held them for a long period of time, you didn't get a great rate of return. Now, you'd never know this if you just looked at a model portfolio or used asset allocation as the primary driver of how you make decisions around these things. But this again just shows that the comprehension is gained via the construction. And if you don't do the construction, you're unlikely to do the level of research that would highlight some of these deficiencies. Ultimately, this doesn't mean that model portfolios are a bad thing to use. And here's my quick summary opinion of when it should be used and for whom they should be used and for whom alternatives might or should be considered. Model portfolios are useful for low anxiety, low neuroticism individuals or couples. And this is going to more often be someone who is in the earlier stages of their retirement planning or investing career. And that's because the focus when you're young and investing and saving is really primarily on saving. The more you save, the more money you'll have as you arrive at retirement. You're also at a lower level of peak wealth, and you're many years removed from retirement, so you're less connected or less sensitive to your actual investments, and therefore you can use a model portfolio to greater effect because you're not going to be doing all sorts of proactive actions in there, and really your focus should be on saving. But as you enter the retirement risk zone, it's kind of inevitable that you're going to feel more sensitive to your investments, and you're going to wonder more, are these suitable for me? And you're going to have more questions because you're close to target retirement date, you're closer to your peak wealth. These things matter more because they're impactful, and most cases, regardless if you're using a model portfolio or not, you're going to have a higher level of anxiety and interest in your portfolio as you get into the retirement risk zone, because that is just inevitably the case as you start to have to make decisions about when do I retire, how much money can I take from my portfolio when I retire, etc., etc. And it's my opinion that as you near retirement, model portfolios become less and less effective for retirement investors because the model itself may be useful, but the human behaviors don't track alongside well with using a model. The human behavior is such that as we enter the retirement risk zone, we become more sensitive to our finances, and we therefore need a higher level of comprehension. You can use a model that way, but you're going to end up doing more research and kind of needing to understand and dig into the model itself to understand what you're really holding, and then make a decision if you need something more complex or more accommodating of your particular situation. Ultimately, this video was simply designed to help think through the trade-offs, the pros and cons of a model portfolio, and I hope we've done just that. I do appreciate your time and attention, and if you are entering the retirement risk zone, it is okay and natural for you to feel more sensitive to your finances. You probably should. All that being said, hopefully videos like this help kind of increase the level of comprehension and understanding that you have, or help you understand how to do the research around these things. So if you have any questions or you'd like to understand a little bit more about this subject, please put those in the comments section below this video. You can also send us any questions you have through the contact forms on our website at www.thepeakfp.com. We've got all sorts of helpful guides on our website as well, including sample financial plans, 3-bucket strategies, and all sorts of other stuff. You can go to www.thepeakfp.com. And if you'd like to, you're more than welcome to schedule a free consultation with us and our fee-only fiduciary financial planning team. You can do that using the link in the description to this video below, or by going to our website. As always, thank you for your time and attention. We appreciate your trust, and see you in the next video.